Hello there. Welcome to Blacked Out Forex Academy. This is FX Blacked Out 1.0 Introduction to Forex Trading. This is lesson 3. So we're actually continuing from lesson 2. So if you haven't watched lesson 1 and lesson 2, please make sure you do. If you don't have access to these videos, please make sure you ask from your admin so that you can have access to these things. So right now, let's get started. All right, so today we're going to look at the common terms used in Forex trading. So guys, the question should be, why is it that we're taking so much time on the foundations, learning the introduction? All right, guys, remember the most important part of the building is the part that you don't see, which is the foundation. This is the most part that most people don't talk about in Forex trading. And you may find out other people are actually failing, actually losing money in Forex just because they missed some of the things that they should have known during their foundation stage. So most people you tend to skip this part because it looks like it's not important, it's not necessary, it's not what. But I'm telling you guys, if you get to know the foundations, understand these things, you're going to have a greater strong foundation, a concrete foundation as you go, because you'll be understanding things better in a much more sensible way than somebody who just latched into the process of making money. So if you get more time to understand the foundations, you're going to reduce amounts of error of losing as you go along. So guys, let's look at the common terms used in Forex trading. So the first term that we're going to look at is what is here, buy. So buy is the same as, we've already said that buy is like you buy something that is on the market, that is available. And the same, another word that is used as an alternative to buy is ask, right? This is an asking price. If you want to buy something, you bid you ask you put your asking price, like this is my asking price, if you know. And then if you want to let's say the same thing, that means you can also use the word long, right? You can use the word long. They're all related. And let me bring you here. The same thing is that long is equal to buy, which means long is same as buy. It's all like, if you want to buy some, if you are buying something, it means you're going long, right? You're going long. And bullish, bullish is just that price is always buying, right? If something is going up, which means that thing is in demand, is actually in demand, right? But that is why it's actually just going up, increasing in price. So these are actually related terms: buy, ask, long, bullish, and yeah. So I'm pretty sure you guys are taking notes, because what I'm dropping here is value, guys. If you have a journal, if you're putting down whatever I'm teaching you here, and always look forward to at your free time, just make sure you internalize everything that I'm teaching you. It's going to be 100 plus for you, because um this is amazing, guys. So when you buy, you expect price to go up, okay? Same as what's here. When you buy, you expect price to go up, like you expect price to go bullish, right? So when you sell, you expect price to go down, which is, now we're talking about selling, right? You should sell, same as bid, same as short, same as bearish, right? When you sell, you bid, you short, and you expect price to go bearish, same as here, which means if you had put a short, the same as sell. You're in the expecting price to push to the downside. Okay, I'm pretty sure you guys, we are all together. And then there's a very good example here on Euro USD, whereby we are seeing a sell is actually equal to bid, right? And what buy is equal to ask. This is ask price, this is a bid price. So it's actually called a bid price, because when you bid, you're going to bid at this price. When you sell, you're going to sell at this price. And when you buy, you're going to buy at this price. I hope that makes sense. All right, so these are very important terms, and the most common ones that you're almost in your whole entire trading career, you're going to use these words like buy, sell, long, bullish, what, and then yeah. So let's move forward. So now we are on another term another terms, which is buy limit, buy stop, sell limit, sell stop. So now let's look at the first one, which is here, buy stop. What is buy stop? Okay, so buy stop is when you place an order above the current market price, right? When you place an order above current market price, what I'm trying to say is, let me give an example. Let's say soya or maize, right? Maize is actually being sold at 20 kwacha, right? 20 kwacha per kg, right? And then you feel like, but I'm not sure if price of maize is going to ever sell above 20. Of course, every time it's just 13 or 15, sometimes 20, sometimes 12, sometimes 22. And then you'd be like, but as soon as the means of price just go below 25, it'll never go down. It'll just keep on going down up. Like it keep on getting expensive to 30, let me be 40, right? And then you'll be like, but this might not happen now. And it can even happen drastically. So what I'm gonna do, I'm going to place my orders. I'll place my orders on buy, on 25, so that if price happen to reach 25, that means my orders will be activated. I'll be in the trade, okay? My orders will be activated. I'll be in the trade. And as a result, I'm no longer looking forward to see price going down, but I'm looking forward to see price going up, which means on 25, I'm going to put my buys, right? I'm going to buy. So this is what happens. Let's say this is the market, and then this is your 25 level, and then price is just coming here, coming in, and then it comes on above, right? And then that means you're going to be activated in the sell, in the buy. So which means you're expecting price to be doing this, right? That is actually what is called a buy price, okay? That is actually called a buy stop. A buy stop. So orders are priced above the current market price. Orders are just priced above the current market price. Like remember, we priced here, price was down here, so that as soon as price breaks, you're going to be activated in the cells. That's all about buy stop. So sell stop is actually just the opposite. Remember, as illustrated here, assume this is actually the current price, and this is above the current price, and price is actually broke. Where it breaks, it's going to activate you and put you in the sell, in the trade, which is the buy. And the opposite is true. Remember, order price are priced below the current market price, and which means if actually price is actually trending somewhere here, and you'll be like, if price just ever go below this level, I want to be selling. Okay, so you're going to place your order, and that order is called sell stop, right? That order is called sell stop. That is why it's price is actually here and it has been priced here, and then what the order has happened, price is actually dropped below, right? Like this. So as soon as price passes this level, that means your order is going to be activated, right? Your order is going to be activated. These are actually called types of orders in Forex, okay? But I'll explain them, but just pay attention to what is happening right now. So that is actually a buy stop, right? That is actually a sell stop. I hope I make sense on that one. So a buy stop is just the opposite of sell stop. The concept is actually placing your order above or below the current price, okay? So now let's look at sell stop. Sell limit. What is a sell limit, right? Sell limit is actually, let me give you an example for you to understand the sell limit, okay? Price is actually going up, but then you'll be like, no, this price is very expensive. Like this is too high. I'm willing to buy only if price gets here, right? Okay, let me give you a quick example, because I was giving you an example of buy limit. But yeah, so price is actually trending here, and then you'll be like, no, this is too low, but I'm willing to press my sell here, right? I'm willing to press my sell here, so that if price comes here, my order sell is going to be activated, right? So what is going to happen is, if price ever never get in your zone, which means your order is never going to be activated. But if price goes up and do this, like activates your order, and then trends, and then go down, right? Which means you're going to be activated in a sell order. It's just like buying ready for the future reaction of the market. So the future reaction of the market has responded with this move, and the price has actually pushed down. This is actually what is called a sell limit. A very the similar price to buy limit, just an opposite. Like price is going to be like this, and you'll be like, no, I need to press my buy limit somewhere down here, because I'm expecting price to come here before it goes up, and then price is gonna be like this and then continue going up. Your buy limit is going to be um activated. So these are actually the buy limit. There are only six common buy orders that you need to know. So the first one is actually the buy, and then there's actually another one which is called the sell, and then there's this one, and this one. So I want to explain the buy. So let's say price is actually going up, right? So if you don't want to use any of the orders like this, what do? You can only buy. You can only buy here. If you buy here, that means instantly you've bought, right? You've actually agreed to the contract that I want to buy here. So price is actually going to go up. Or else, if price is actually going down and it's actually here, if you press sell, right, you're going to agree to the contract that you want to be selling. Okay, so that's what happens. This is actually an instant market execution, whereby when you buy, you have bought. This is actually called a buy limit, and this is actually called sell limit, whereby you're actually waiting for a certain price, like price to come in that an area of interest so that you can be selling, or you're actually waiting for a buy limit whereby price can come in your area of interest and start buying, or else you're actually just expecting to see price pushing up from that level, which is a buy stop. I hope I've made myself clear, guys. If you don't understand anything, please let me know. Now let's move forward. So all these orders are actually used. Sometimes we use buy stops when we're actually trading assets that are very volatile, that jumps. Maybe we don't know, maybe price has just been doing this, and then we're expecting price to break this high, but we don't know when it might happen. We can just press a buy order and go away, because even if your phone is off, even if your phone is off, you're sleeping, if price gets here, your order is going to be activated. So you're going to be, when you're waking up, you're just gonna find the market is in profit. Or else, if you actually want a buy stop, I mean a buy limit, you just press it and go do something. So you actually use these things whenever you feel like you're busy, you can't wait for the market to do all the thing before it comes in that area. So that's why you use the buy limit, the limit orders. But if you're there, you're watching the market, then you execute instantly. Buy stop, I mean with a buy or with a sell. Okay, so now let's move forward. Okay, so another common term that I used in Forex trading is a lot size. What is a lot size? So a lot size is just like a contract size, okay? A contract size is the number of shares that you, like just the number of shares that you want to buy. If you go to a company, they'll be like, one kwaja is equal to, let's say, one share is equal to, one kwaja, right? One share is equal to one kwaja. Maybe they would say this is the least, right? This the smallest. So the thing is, so this lot size, I would say it's just like a number of shares that you want to buy. Okay, so if you take one quad, which means you're getting one share. So which means on every movement that the company is making, which means this is your one share, one share, one share, one share, one share. Or we can take a lot size as a cup, right? As a cup, okay? This is this cup, right? This is like what you're going to be using. So lot sizes, they're actually, it's a size. So there's a small one, there's a smallest one, there's a smallest one, there's a smallest one. So let's say you have actually, when you choose a small lot size, okay, you will be able to, let's say, to draw water in a very small portion. If let's say, if you're drawing water from this portion to this basin, right? If you're drawing water from this portion to this basin, so this basin is actually your bank account, right? Your bank account. And then this is actually, let's say, a pond. This is actually a Forex market. So you take this cup, you pick water, like you draw water. And then let's say there are obstacles here. If you draw water and then you meet the obstacles, or then you survive the obstacles, you come with a drop of water from this cup successively, okay? And then you draw another cup of water. Then you're coming here, then you made obstacles, you drop the water spill on the floor. And then the amount of water that you're going to lose are going to be very small, like just like what you have put here, very small, okay? And then if you take a big cup, you're going to draw a lot of water. And then if you bring the water in here, it's gonna be a lot of water. But what happens when you lose, when you drop the water, right? You're going to lose a lot of water, okay? So this is actually what a lot size is all about. A lot size is just like simply a contract size. How much are you willing to make on the trade? How much are you willing to make? So how much the contract, a lot size will look like this. This is actually a lot size. This trade is GBP, is Audi, which is Audi JPY. But on Audi JPY, they're actually selling. But even though they're selling, his contract size is 0.05. But does this mean this is the lowest lot size? No. What is the lowest lot size? The lowest lot size is 0.01. If you use 0.01, it means you're using the lowest lot size. But the lot size can go up to 100, right? 0.00. Lot size can go even up to this, but you cannot get to this level before you humble yourself and use this lot size, because sometimes lot size will also depend on your bank account. Like this is a $22 account, and then they're only using these lot sizes. But I would advise you that when you are trading, make sure you use lot size 0.01. Yeah, the fact is you're going to make small amount of money, and you're also going to have chances, you're going to also limit chances of losing a lot of money. In this case, you make you not make a lot of money, and you not lose a lot of money. That's the good thing of using the smallest lot size. But the biggest lot size is that you're going to lose a lot of money, and you have chances of making a lot of money, okay? So having a very nice lot size is good. A very small lot size is good, because it's actually part of risk management. So I would advise you, when you open your trading accounts, don't just jump in entering 0.1 0.1 or just 1. No, use 0.01. okay? That's how you grow, no matter what. It's not about getting rich quick. You don't have to make 1,000 in a day. It's about being able to understand the market on a daily basis, that one day we should make 1,000, okay? So that's about lot size. So now let's talk about a profit. What is a profit? A profit is what you and me are all about, what you and me are all after. So you can see this is a profit here, 85 dollars 76 cents. This is a profit. Whenever you see blue, just know that's a profit, okay? That is actually a profit. So a profit is just what a trader has managed to make. So in this case, this is actually what this trader is making. He hasn't yet closed this trade, but this is actually a profit. His trade is actually profiting as we are talking, okay? So the profit It's going to be here, here, here. So the sum of this profit is what you are seeing on top here. So you're going to see a sum of all the profits landing on top of somewhere here if you're using an MT4 or MT5, okay? So what is a position? A position is actually simply a trade that you have took. Let's say you have taken a trade here. You have taken a trade here, right? This is Audi JPY. This is actually a position, okay? This is the first trade. And then you have taken another trade here, all right? This is the second trade. But then let's see on GBP, on Euro GBP, there are two trades. There's this one and then there's this two. So this is actually one trade. This is one trade. GBP, that is one trade because all these trades are taken at the same time. It's very possible to enter two positions on the same trade. So you should need to understand that this is a position and this is a position, but both of them are one trade. Okay, but this is a position. It's like this one is the first position, second position, third position, fourth position. These are actually my positions of trades, but these are only three trades because this one is different. This one is a different pair, and then these two are different, and then this one is also on its one. I've actually took three pairs, okay, three trades because these are three different pairs. But when we talk about positions, we're just talking about what contracts are you learning, okay? What contracts are you learning? So position is just simply like what contracts. So there are 4 contracts, 4 positions, okay? So now let's go forward, or before we go further, let's look at this this thing here. So you can see if you're going to buy at the right time, okay, at the right time in the right moment, and then the trade goes in your direction, like what is happening here, right? Which means you're going to have a chance of making a profit, okay? So which means I bought this market right here, and then price was actually going down. This was actually giving me a chance to be in profit. Okay, so that's what it means to be in profit. When you actually say I'm selling and then price goes in a direction, you're going to be in profit. So the next thing is a demo account. What is a demo account? A demo account is just like a free, it's just like a practice account that a broker offers you to be practicing. They put fake money in that broker so that you can be trading like real money. So a trader is going to be using a fake account as there's real money. So you're going to be practicing entering trades. Sorry. Yeah. So you're going to be entering trades, just doing anything that you like what you do on a real account, so that you can familiarize with yourself with what happens on the Forex market. So that is what a demo account is. A demo account is always available when you just install your MT4, you find it, your MT5, you find it, and you have to choose a suitable balance, because you have to choose how much you want to be practicing. So when you choose the least amount, it's actually good. And when you're even opening a broker, don't rush to open with thousands of dollars in your demo account. Open a demo account with at least 100 or 50 or 300, because you need to be realistic. When you open a new account, you want to find your account with so much money in the first place. Okay, so a real account is an account that you fund your real money. That's where you blow. You make money or not, because in a demo account, you cannot withdraw. Even if you make thousands of profits, you cannot withdraw. Even if you make thousands of losses, nothing happens. It's just for you to practice, okay? So let's move forward. Yeah, so we're currently on losses and bro. What is a loss? Okay, a loss is when you are saying, okay, fine, I want to take a buy here, and then you buy, and then what happens? Price goes in the opposite direction. Okay, what happens? You make a loss. You make a loss. So you can see, like, this is a loss, and if you can even see my contract size, my lot size is very big. That is why I'm also having a very big loss. So this is a huge amount of money in a big loss. You can see this is bad. so bad, right? So that's actually a loss. And you say, I've taken a loss today. Ash, I faced a loss. So it's actually part of the game. Don't feel bad when you take a loss because we always learn from our mistakes, and this is a part of mistakes. So if you take a loss as a loss, you're not going to learn, but take a loss as a lesson. Just find out why you have lost the money. So when you actually lose so much money up until your deposit, the money that you funded is all gone, then we say your account is blown, it's gone. I've blown an account. It means that the amount of money you have failed to make money in Forex, instead you have lost everything, then you have blown, period. Okay, so let's move forward. So this is actually one trade. You can see this is actually one trade. This is actually one trade. Why? Because it was taken from a same pair, but no, all these, this is one trade, except why? Except this, because this is actually the same pair, but it's buy, but it's sell. So it's actually different. But this is actually a lot of positions. 1, 2, 3. I don't know how many. Yeah. So let's move forward. Okay. Yeah. Take profit. What is a take profit? What is a stop loss? What is break even? Okay. So now let's start with take profit. So I'll take you from here. Whenever you are entering any trade, you are going to have two options. I mean, three options. Entry level. Entry level, that's where you execute the market. Okay. So in this case, I chose to execute the market right here, right here. And then you see this level. This is where I've decided to put my stop loss. What is a stop loss? A stop loss is how much you are willing to lose, right? How much you're willing to lose. A very good example is here. You see, I'm actually willing to take a buy here, but I have actually put my stop loss down here. Why? A stop loss is just like a shield that stops you from losing so much. In the case whereby I bought and then the market starts going down, if my stop loss is here, this trade is going to be automatically closed. Okay, right? Why? Because I've put my stop loss, and this is actually going to happen even when I'm there or I'm not there. Okay, so that is what actually it's here above here. This thing, the dark area, right? That's actually my stop loss. It's actually telling me that if I go up, if I happen to take a trade and the market goes up, I'm going to be stopped. Why? Because I don't want to lose a lot. The more the market goes in the opposite direction from where you have bought, you're going to make a lot of less losses. Okay, so in this case, that's where I put my stop loss, and your take profit is actually where you're expecting the price to reach, like where you're expecting the price to reach so that you can take your profits. So this is actually a price whereby if I press my take profit here, market is going to come here and automatically reach this area. As price reaches this level, it's going to close automatically on my trading platform. Only if I have set that number that at this point, market should close on its own. Even when I'm sleeping, that is going to happen. So you can even see that before I took this trade, I had set my take profit, my stop loss, and you can see this is the before and this is after. Price actually came and boom, reached my zone and gave me a take profit. Simple like that. The same as this one I've already explained. So break even. What is break even? Break even is when, right? Because this stop loss and this take profit, they're movable. You can actually modify them. You can actually move them here. You can actually put them here, put them here. So break even is when price, let's say you have actually entered a buy here and then price is actually reached here, right? And then you'll be like, oh, price is actually reached here. Let me move my stop loss to somewhere here. Let's say you have moved your stop loss to somewhere here, right? And then what do you see? Price is actually coming down, coming down, coming down. And then do you see this area, right? Price is actually tapped here. As soon as price tapped in your stop loss, you're going to be stopped out, right? And it's only called break even, right? It's only called break even if you have actually if you have actually moved your stop loss to exactly where you entered the market. It may not be exactly, but maybe just 3 pips above, just a small distance like here. As soon as price has tapped out, has tapped on your price, it's going to close that trade because you actually put a stop loss. You're actually protecting your money. So that trade is going to be closed. That's what is called break even. But if you're going to put your stop loss, let's say here, let me say here, by the time price is actually here, and then the price actually came down and break you out, that is not a break even. Why? Because a break even is whereby price is going to take you out and you make zero amount and you lose zero amount. Like you don't lose anything. Well, stop loss down here, there's amount that you pay, like the amount that you lose. Let's say $10. That's when you say, hey, stop loss hit. But when you say break even, it's when by you have moved your stop loss to break even. And I advise you to always move your stop loss to break even because it actually protects your money from whether it's better not to make anything or not to lose anything, but to be on the safer side. Okay, so that's what it's called, break even. Okay, so I'm pretty sure that's clear. Let's move forward. Okay, so now let's talk about these things. What is a pip? A pip or pips? Forex lesson. What is a pip? A pip, remember the Euro USD, there's always a number. Can either be on a bid or ask. So a pip, this number, this last number at the end is what is called a pip, right? Is what is called a pip. So this is a pip. This is a pip. Pip is just like a number. So you count these pips. This is actually 10 pips. I mean here, 10 pips. This is actually 100 pips. And this is actually 1000 pips. Okay, so yeah, it's not a big deal. Just understand what pips are. In this case, this is a pip, a pip, a pip, 10, or a pip, 10 pips, 100 pips, and 10, something like that. Okay, so what is a spread? Yeah, so the market always be moving these numbers one by one. Like sometimes it will be 1, 1, 0, 5, 2. So as the price is actually bullish, it's going bullish or going up, these numbers are actually increasing, okay? Which means the price is actually increasing. But these numbers are decreasing, means the price is actually done in bearish, is decreasing. So that's what a pip is, right? So the price will be just moving in pips, 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 pips. These are the things that change, okay? So now let's talk about a spread. What is a spread? A spread is actually the difference between a bid and ask. If you're going to subtract this number from this number, you find that this answer is 2 pips, okay? So remember, we are subtracting this from this, and this is 2 pips. So a spread is the amount that you pay, is the fee that you pay a broker when you're opening a trade, right? If you want to participate in a trade, you pay a certain fee, and that fee is called a spread. That spread is what you're seeing here. And the spreads, they do vary from broker to broker. Remember, we say when you're looking for a broker, you have to look for a broker that has got a low spread, because it's this spread you're going to pay on every position that you open. Okay, every position that you open, you're going to pay for this spread, for this spread. So some brokers are going to have like 20 pips, 20 pips spread, 25 spread, 40 spread, even 100 spread. So you have to look for a broker that has got even the smallest spread, like 2, 5, 10, whatever, 15. Those are okay. Okay, so another example of a spread is like you're going to pay a broker this spread. Whenever you enter a trade, you're going to land in losses. You'll never be in a profit as immediately after entering a trade. You're going to be in losses. And whenever you land in losses, those losses are actually paying for the spread. A very simple example is when if you have seen people who sell things in free market every morning, there's actually this person who actually receives money. He actually receives money. People, they pay fee for selling in that free market. Okay, you see, I hope you understand what I'm talking about. That money everybody has to pay before they sell anything. It's actually 20 kwacha, 50 kwacha. That's a spread. You actually pay the market for you for you actually pay the market so that they can let you participate or do business in that place. So that's how bloggers make money. They make money by letting you do business in their space by making you pay a spread. Okay, so I'm pretty sure a spread has made sense. Another thing is leverage. We have already looked at these things, but I want to explain them in a more detail, in a detailed manner. So in leverage is actually a booster. It's actually a loan. It's actually no. It's actually a ngongole that a broker pays you. Okay, what do I mean? Remember, I said that the forex market is a huge market whereby um it's actually actively participated by big people. Big people. When I say big people, I'm talking about people with a lot of money, like billions and trillions and thousands. And then you and me with our $10. When you put it there, it's actually like it's actually way too low, man. We can't actually make money because it's for the big boys, right? So whenever you find a broker will be there to lend you money, to borrow you money, right? So a broker will lend you money to boost your money. So you can see this is your money, and then this is the blogger's money. And actually now it's balancing, which means you can participate on the Forex market, right? You can participate on the Forex market because they've actually boosted your money. Okay, I'm pretty sure that makes sense. So they'll actually take your $10 and then they will take their $50 and add your $10, and then it will look like 50,000 $10, and then you'll be able to participate in the forex market. As soon as your $10 is gone, they're going to take the $50 away and keep it. Wait for someone to come so that they can borrow him and use it. So that's that's what happens. Like you see, as soon as they see you're defeated, they'll keep their money. They don't lose by giving you money. You're the one who lose your money. So it's very good to choose a broker that